My name is Phil Dettwiler. I'm the head of custody, storage, and transaction banking of SEBA Bank. For the ones who do not know SEBA Bank, we're one of the globally first fully fledged, fully licensed banks with a banking and security trading license with a focus on digital assets. So what we would like to achieve today is give you a little bit the sense of this interplay between lending and custody. We're going to guide you through the why, what, and how you can get that exposure. Now, this will be probably the simple slide you see here at this summit. It is simple, but I also do believe it is the essence of why it can be interesting to lend in the crypto space. As in the normal industry, traditional industry, we have the same interest also in the crypto collateralized industry, where hodlers are interested in monetizing their digital assets by getting fiat liquidity. But we also do then have the traders who would like to enhance their returns by leveraging. Thirdly, we do have the general investors who are interested in diversification. By adding crypto, by monetizing crypto, you can actually improve your risk-adjusted returns. Now, let's go into a market sizing. We see that the financial wealth at 220 trillion US dollars is fairly big, and the non-financial wealth with about 190 trillion US dollars, where we're talking mainly about real estate, is also very big. You see that Bitcoin and digital assets are dwarfed by this massive market. Nonetheless, it is a very important market from a diversification perspective, but also from a return perspective. Now, we need to be aware that the crypto lending market is has a direct relation to the overall market size. So the size of the crypto lending market is a function of the overall crypto market. If we now drill down a little bit more into those details, the details of the crypto lending market, which currently stands at about 1.6 billion US dollars. So this is currently roughly 1% of the Bitcoin or crypto assets. We see potential in the future where this market might go. So I would like to ask you to take these numbers we're showing you here a little bit with a grain of salt. They might be appropriate, they might be a little bit off, but they should give you an indication where the market, we believe, generally heads to. If we start with a custody or with crypto assets of about 300, 400 billion in 2020, end of 2020, we do believe by 2029 this could go up to about 6,200 billion. We also believe that the share of the lending will increase from approximately 1.5 to 6%. If you add up those numbers then, you're finishing at a market potential of almost 400 billion of collateralized crypto lending. And I do believe this is a fairly interesting approach. Also here, with these indicative rates, please take them with a grain of salt. I was speaking with a couple of you guys yesterday evening at the networking event as well, and everyone told me how difficult it is collecting those numbers and getting a little bit an overview. You can't compare them one-to-one. You have different LTVs, you have different minimum amounts, etc. The numbers in the back, they just should give you two messages. Firstly, the rates are very dispersed. Secondly, the rates are fairly high. Why is that? We do believe that the market is still fairly inefficient, and this is why you can observe those rates. Now, if you would like to go in a state of that industry where the entire crypto lending industry becomes more efficient and rates come a little bit down, we do believe that particularly a bank can add additional value to bring down those interest rates. There are basically three different attributes that would support this statement. It is from a regulatory and supervision perspective, where you can instill confidence in that market, and it is also important that you have strong shareholders that also raising their hands if the bank is not moving in the right direction. Secondly, on the financial side, a balance sheet is important that is backing up also the loans from a security perspective. You also should have additional funding access. So this is possible when you're basically can tap into the funding market as a bank. And very important, where Paolo will refer to in addition, is that when you're holding the actual collateral and you're not going over a synthetic crypto exposure, you can also mitigate the counterparty risk. Now, talking about risk, it is paramount that when you're holding the actual underlying the collateral, that you safekeep it, that your collateral is safe. And this is why I briefly would like to tap into the technical aspect, where we believe it is important that you do have sound custody storage solutions. We believe it is important that you have a flexible approach. That means you have custody storage solutions for different use cases. If you have trading clients, if you have clients who would like to have quickly access to their funds, but also offline storage solutions. So if you can offer that all out of one hand, you have a convenient setup. I'm also mentioning here on the partner section, customers of ours approaching me oftentimes, but isn't it very difficult to hold crypto, or isn't it very expensive? It is when you're holding it on your balance sheet, but you don't need to hold it on your balance sheet if you partner up with a bank and it is not your proprietary funds. If the funds are your proprietary funds, it is indeed very expensive. For example, in Switzerland, FINMA is requiring an 800% capital underpinning, which is very expensive. And the BCBS report even suggests 1,250%. If some of you guys are interested to go into more technical details about that safety, I'm more than happy to discuss later on with you. As such, I believe we have set the scene that we now can go into the different use cases, how the crypto collateralized lending is actually really working. And so I'm heading over to Paolo Pasqualini, my colleague and head of credit of our bank.
Thank you, Phil. So hello, everyone. I'm Paolo Pasqualini, head of credit at SEBA Bank. How does a bank fit into the crypto lending market? As you probably know, the market has lenders, crypto lenders and fiat lenders. I would start from a word which always strikes me, being an Italian speaker, credere, believe. The whole banking business and the whole credit business starts with the trust. And I think, I'm convinced that a bank can add trust to the crypto market and to the lending market. How? A bank is per definition regulated in every country, has to adhere to Basel III standards in terms of capitalization, liquidity, and eventually profitability. Profitability is not mandatory, but shareholders are very keen to get a minimum return on their capital. As a bank, we have a strong balance sheet, and we have the liquidity to facilitate more lending in the crypto market. And who are our target groups? Or who are the target groups of a bank in the crypto market? As we have seen, First of all, there is 3 use cases that Phil has already presented to you. And one is the return enhancement, that it's the first thing which comes to mind when you think of cryptocurrency as an investment. You want to invest, but some investors want to leverage, want to increase their exposure to cryptocurrencies, and they use leverage as a return enhancement method. But equally important is to get fiat liquidity out of your cryptocurrencies, because if you are a buy and hold investor, if you are a hodler or a miner, you don't want to sell your cryptocurrencies every time you need some fiat liquidity, and credit gives you the possibility to access the liquidity anytime with no fixed costs. The third use case is diversification. We all know that equity markets are pretty wild right now. I think when you see the crypto markets, I wouldn't say it's digital gold right now, but it's something which is increasing the risk-adjusted return of your portfolio, because it's very little correlated with the equity and bond markets. When it comes to the target groups, what a bank like us is seeing right now is that lenders do need other lenders. So if they lend fiat, they need to refinance. They need access to fiat liquidity to keep expanding their balance sheet, to keep on lending. And lending is profitable business. So we as SEBA, we get requests from different OTC liquidity providers, exchanges, to get fiat liquidity. And obviously, the market is very much tilted towards USDs, because it's the reference currency when it comes to converting crypto to fiat. I mentioned before hodlers, but you can read miners. So people who have a long-term view of where the market is heading are not keen to sell their assets whenever they need to buy real estate, for example, or to invest in their business, or to buy a durable good. So crypto as collateral is an effective way to access the fiat liquidity they need and be flexible to repay it whenever they don't need it. So the LTVs, I don't know if you're familiar with this concept, the loan-to-value ratios we see are lower, because this type of loans have more longer-term character, and people like hodlers don't want to be bothered with margin calls, with closeout. They want to access a facility and have this fiat liquidity for the time they need it. The third use case, maybe the most immediate, is the one of traders. So people who want to leverage their exposure to crypto markets, and they want to have LTVs which are as high as possible. Obviously, this sort of leverage is more short-term in nature, because you enter the market full steam ahead, and then you want to exit possibly at the highest possible point in time. The interest cost is tied to the actual amount drawn and the tenor of your loan. Normally it's short-term, so the interest cost doesn't really affect your returns, because your returns are, as we see with a lot of volatility in the crypto markets, can be significant in the short term. This is an example of how a bank monitors crypto-collateralized loans. We have, as the market works 24/7, we need to have 24/7 monitoring, which is largely automated. So it happens through alerts whenever relevant triggers are hit. The concepts are the same like in other collateralized loan types. So we have margin calls whenever the collateral level drops below a first trigger, which is always below the day one value of your crypto collateral. And then as a last resort, we have the closeouts, which is a partial liquidation if your price drops as much that your equity is in danger. So it's a sort of a stop loss to avoid risks for the bank and for the client of a full loss. a last slide gives you an overview of how diverse and how rich this market already is. You can see there is a lot of subsectors, and that gives you also an idea of where the lending is placed, crypto lending, and it's very close to custody. And the reason why we are here today having a joint presentation is because we believe that custody with lending gives really a competitive edge and added value to clients, because they have the security of custody solution, but they can also access liquidity whenever they need. So I thank you for the attention, and I'm happy to answer any questions now or later in private conversations. Thank you.
Thank you. We do have time, sorry. We do have time for a couple of questions if there's any from the audience.
Patrick, do you work with other lenders in this space, or is it competitive?
We work with lenders, with not for fiat. We do not borrow fiat money. We have fiat money, and we are able to tap fiat liquidity from traditional banks. We work with other lenders when it comes to crypto lending, so when we need to borrow cryptocurrencies because we do not have enough, and sometimes we go to Genesis, to Galaxy Digital, and so on. So yeah, we have a productive cooperation with them. So,
do you do uncollateralized loan, or do you see any player in the market doing crypto?
SEBA does not do unsecured loans. We see players which do partially collateralized loans, so not fully collateralized or not over-collateralized, but partially uncollateralized. I think it's not something which should be used on a wider scale, because you have to monitor the counterparty risk, and it can become quite tricky. You have to receive at least annual financial statements, if not quarterly or half-yearly. So it becomes trickier because it becomes cash flow based. So you have to assess the counterparty risk, and it's not, it doesn't play a major role, right, in the business. Yes. Sure.
I'm just going to ask, for traders, do you issue and work with the loan for leverage in like stablecoin tokens? And if so, is that done on your exchange, or how is that enforced?
We do not use stable coins. I mean, we are pretty traditional in the fiat liquidity that we offer for our loans. So no, we don't use stable coins. As a bank, we prefer to stick with USD, euros, francs, sterling, and just have crypto collateral. And we are very happy to have Bitcoin, Ethereum, Litecoin, so currencies which are liquid, where the daily volumes are sufficient, but no stable coins.
Cheers. Thank you.